All right, good Monday afternoon, coming to you late Monday, where we've got a pretty good rally going. Hope everybody was buying the dip last week, or at least executing your game plan. If it called for buying the dip, if it called for buying at lower lows, because that's what we've seen all year, is lower lows pretty much every quarter. Good on you. Somewhat anticipating this rally. Well, I shouldn't say a rally. No, I am anticipating a rally, but definitely a bounce of sorts. Have been anticipating that over the weekend. My name is Seth Golden. This is our Finom Group weekend research report review video that we've been doing on Mondays more frequently. If you are not a subscriber to phenomgroup.com and you don't receive our weekend macro market research report every Sunday, subscribe so that you can get it in real time rather than having to wait for this video. And this video is more concise. I can't go over all the concepts in our weekend research report, or we would be here forever. With that being said, title of this weekend's research report: haven't broken the bear's back just yet. We're trying to push it down, but the bear is alive and well. First chart, right? Because all we've been hearing about is this is not just a terrible year for equity markets, it's a terrible year for the bond market as well. We get so wrapped up in the here and now and the results of the here and now that we kind of forget what happens historically after these rather anomalistic periods where both bonds and equities are down together, not just down together, but in bear markets together. Like, it's a very rare occurrence. This chart right here from Ned Davis Research, as you can see, it happened in 1931, both in bear markets. Happened again. It's looking like 1973, 74, and here once again. So again, the chart, it just looks ominous. But when you look forward, right, because we're investors, we should be looking out in advance. We should be looking to the future, not just have tunnel vision, dealing with the present day circumstances. And what we see is the next 2 years, after both are down 20%, bonds and equities, 60-40 portfolio, if you will. The next 2 years, strong returns. Next 2 years, strong returns. We'll see. As I said, the sample size is small. It's only happened, going back to 1931 twice to this degree. But both times we had double-digit returns in the following year. Seth, you're being too optimistic. What choice do I have? The optimists get paid. The pessimist always sounds smart, right? It sounds smart to be cautious, pessimistic, to second guess everything. But those people don't get paid. It's the optimist that gets paid. All right, let's see where we're going from here. One of the other concepts I've talked about in the weekend research report is, right, because I know that there's people, well, I moved to cash, or I'm hiding out in the defensive sectors. You're not hiding from the bear market. Nobody hides from a bear market. Okay, the bear market comes for everything. It's just a matter of when it gets to you. Right, everything has had at least a 20% correction here, and most recently was utilities. In like 30 days, utilities have been an outperformer next to energy this year. But lo and behold, the bear market did come for the utility sector as well. And in bear markets, you kind of lose your discipline, right? People do things that they otherwise wouldn't do. But in bear markets, they're breaking disciplines. They're trying to move to cash. They're moving to healthcare, utilities, consumer staples, or what's working to some degree. It's not working as well as it was through the second quarter of the year, but energy. Right? When you make those kinds of changes, knowing that the bear market is eventually going to come to you, where do you think your psychology will be once you've made those changes? And by the way, those changes didn't work either, because the bear market came for you once you had made those changes. So now you're down even more. What do you think your psychology, your emotional quotient would be after going through those exercises, because you're hearing things on CNBC, we're hiding out in staples, we're hiding out in commodities, we're hiding out in utilities. And then all of a sudden, it comes for utilities, comes for energy, comes for commodities. You think you're going to make right decisions after that? Stick with the long-term strategy, quality stocks, growth stocks, or index ETFs. Don't make it hard on yourself in a bear market, folks. Don't make it hard on yourself. All right, we've looked at this table many a times before. 15% quarterly drops the next quarter, the next half, the next year. 20% 2-quarter drops, right? Only one time has the market been down the next quarter after a 2-quarter 20% drop until 2020, right? 2022, sorry. Now we have 2 times that the market has been down, but after a 20% 2-quarter drop, 2 quarters later, or half a year later, the market has never been down. That's where we are right now. We were down here in the next quarter after this circumstance, and now we're at the 6-month mark, or in the next, in the 2 quarters later. So, is this time going to be different? It was 37.85 after the end of June. Market was down almost 21%. Market is algorithmic. I mean, it was down the price on the S&P 500 at the end of June, 37.85. The price of the market at the end of the September quarter, 35.85. You think that's an accident? Good luck with that. Good luck with that. But we're setting a low bar. We just have to be above 35.85 by the end of the year, and this will still be 100%. And then we have to look forward to, again, 100% of the time a year later, which basically takes us to June of 2023, we would have to be above 37.85, because that's where we ended June of 2022. Moving on. And, what stage of this bear market are we in terms of our psychology? Maximum pain, right? Emotional quotient. Where are we? I think, in this curve, you're optimistic. Excitement is brewing. The market's going higher. There's the thrill, coursing through your veins, and, you hit the peak of the market. There's a lot of euphoria. And then it's like, is this a normal and to be expected correction? So you're starting to feel some anxiety. Then there's denial, because this is a bit more than a normal correction. Now you're just all out fear. Something's wrong here. What am I to do? And then desperation sets in. And that's where I think we are with a lot of investors right now, and why you see them making changes to their portfolio, or just cashing in their chips and saying, it was fun while it lasted. I'm done with this. I think we're in that desperation stage. I don't necessarily think we've hit the panic button, nor do I necessarily think you have to have panic, as part of, that triggers in your emotional quotient just because we have a bear market. It's up to you. Bear markets are to be expected. They're part of a normal cycle. We're in a secular bull market. Inside secular bull markets, you have both cyclical bull markets and cyclical bear markets. Until further notice, this is just a cyclical bear market within a secular bull market. But I do think a lot of people are feeling desperation right now. By the way, you're as close to the bottom as you can get, or what they call maximum opportunity. The more and more desperate people we have out there, more than likely, the deeper the decline in the S&P 500 and the deeper your discount, i.e. the maximum compounding opportunity you have going forward. All right, let's see what else we got. 2 things that we've talked about from a conceptual standpoint as it relates to the Federal Reserve, their fight against inflation, right? And one concept that we've talked about, why the Fed is hiking rates as quickly and with magnitude that they have been doing so, 75 basis point hikes in each of the last 3 meetings. Looks like we're set up for another 75 basis point rate hike at the upcoming November 2nd meeting, is because they want to hit the wealth effect. What is the wealth effect? Well, the average household feels the wealth effect through basically 2 of their asset classes. Their home, if the price of their home is appreciating, they feel wealthier. Their 401k is the other one. If their 401k is increasing in value, again, they feel wealthier. Well, these rate hikes have already begun to stem home price appreciation. So they're hitting the wealth effect from that standpoint. And we already know what 401ks are looking like year to date. So that's the objective. If we can curtail demand, right? Because if you feel wealthier, you go out and spend. But if you don't feel wealthier, you cut back on spending. The demand side of the economic equation cools down. You have slower economic growth. And this is one of the ways that the Fed is trying to fight inflation, through containing the wealth effect. It's a matter of containing it. You raise rates, you hurt the housing market. You raise rates quickly, you hurt the equity market, right? So this is one of the things that the Fed is trying purposely to do. 30-year fixed rate mortgage is as high as it's been since 2000. I'm looking at, I guess, 2003. We have a 7% 30-year fixed rate mortgage, folks. Haven't seen that in a while. I bought my first house, 7.25% 30-year fixed rate mortgage in 2003, by the way. Seems so long ago. Moving on. These are 9 points of interest that I had outlined to Finom Group members back in August, talking about the Fed's current stance, as well as longstanding understanding of Fed projections and policies. Because people talk in terms, and the media convinces us that the path that the Fed is on is permanent. Right? They convince us that this is going to be forever. It never is. Every aspect of Fed policy is open to revision. All aspects of the Fed's monetary policy are open to revisions. One of the key points that I also highlighted within, this numeration here surrounding the Fed, its projections, its policies, and everything like that, was related to this inflation cycle, and more specifically to owner's equivalent rent and shelter, and how it has a significant lag in the reporting effects due to how the data is gathered. And it sets up a scenario of assumed over-tightening. In other words, the Fed knows that rent prices, home prices, which I talk about up here, are rolling over. They're down now since July. Home prices have come down since July. Rent has been down for the last couple of months, depending on who's reporting the data. The Fed knows this. It sees the private data, not just the public data that the government gathers. Nonetheless, the CPI is the public data. It's the government data. So the Fed knows full well that it's going to over-tighten, because it knows that there's a lag in the owner's equivalent rent and shelter price component of the consumer price index, the CPI. And it doesn't care. It wants to over-tighten. That's how fearful the Fed is of an inflationary spiral. It doesn't want to see inflation get embedded, anchored. We don't have anchored inflation expectations like we did in the 1970s or the early 1980s. We don't. Nonetheless, the Fed wants to make sure of it. It's been criticized left, right, front, and center, over the last year plus, for responding too late to the inflation that is now, 40-year highs. So it'll over tighten. But it also sets up the scenario where they can then relax monetary policy. It's a chess game right now between the Fed and expectations. Again, rents have rolled over, folks. Redfin reporting. Jay Parsons often reports on rent, housing market, etc. It's really tough for CPI to cool when its largest component, a rent survey used both for rent and OER, is flawed. Lagged indicator, unlikely to turn until sometime next year. What the CPI shows right now for shelter reflects what occurred in summer of last year, when prices were rocketing higher. We're not going to see that drop off until possibly the end of this year, early next year. It's a lagged report, the shelter component, the rental surveys. So expectations to CPI, to witness CPI coming down in a meaningful way, probably not going to happen until the first quarter of next year. Again, the Fed knows this. It wants to over tighten. It wants to make sure it slams the door on any inflation getting out of control. We don't like it. As market participants, as investors, it makes for a tougher environment. It keeps the wealth effect from the stock market in your 401ks, if you will, under control, contained. This is purposeful. Fed needs every battle buddy it can gather in this inflationary storm. The wealth effect is one. So it means to over tighten. Okay, the other concept, and this is one that might need the context that we talk about needing from our weekend research report. Back in June, this is a look at the Fed's projections. You've heard of their dot plot, right? And the dot plot is not a forecast for the federal funds rate. It's projections based on all of the FOMC committee members. It's their projections, where they think Fed funds rate should go to. Back in June, 3.4%, right? The end of Q2, which found the S&P 500 with a lower low on the year. Fast forward to Q3, September, 4.4% Fed funds rate. That was the projection. What happened? By the end of Q3, a lower low. You think that's by mistake? Right? As we've seen the terminal, we call it the terminal Fed funds rate. This is where they anticipated the Fed funds rate to top back in June. And then at the end of September, they thought it would top, the Fed fund rate would top, all the Fed rate hikes would stop at 4.4, 4.5%. That's no longer the case. When we look out to 2023, they thought it would top at 4.6%. But based on the last CPI reading, they think it'll top out this year at 4.7 or 475 basis points. Why do you think the market made a lower low? A lower low than even September, the end of Q3 period? Because the terminal rate keeps going higher because inflation isn't showing any meaningful decline based on CPI or the producer price index PPI. Because we're not seeing the numbers come down meaningfully, are they down from the peak? Yes. But are they down substantially? No. Ergo, the belief is the Fed is going to continue to raise rates. So investors are pricing in from 4.4, 4.6, now upwards of 4.75% based on the Fed fund futures. They believe that they'll be even tighter. Market makes a new low yet again. Again, not a coincidence, folks. It's called the derating cycle for a reason. Rates go higher, stocks derate lower. So until we see a more concrete top in the terminal Fed fund rate, the belief that this is where it'll top, this will be the terminating point for Fed funds to head to, we're probably not going to see the low in the stock market. No guarantees. And we are starting with James Bullard. Last Friday, James Bullard says, and let's see if I can go find it. I tweeted it out because it's relevant. James Bullard is probably the most relevant of our Fed presidents. Why? St. Louis Fed president, by the way. Why? Because what James Bullard says, I don't mean to say what he says goes, but usually policy works towards his forecast or what he believes, it should be. So Friday last week, I'll get there, folks, I promise. Bear with me. No pun intended. Fed's Bullard. September inflation warrants more front loading, meaning pull those bad boys forward. We're going to do 75 at the November meeting. Maybe we're going to do 75 at the December as well. But pulling forward or front loading the rate hikes does not necessarily mean higher overall rates. So whereas they were looking at 450 prior to the latest CPI, now they're pricing in up to 475 at the December meeting. That's front loading even more. But maybe that's it. Maybe come the new year, the first quarter of the new year, they're on pause. They're giving it time. And if the market believes that's the pause, you could see the floor in the S&P 500 or your indices, if you will. But in my opinion, that's what it takes. If we've been seeing constant upward movement in the terminal rate for Fed funds and making lower lows each time, it serves to figure that if we have finally hit the peak in the Fed fund rate or the terminal projected rate, the market will find its floor, form a base, and potentially start a new bull market. Hope that was clear. And we want to be there for that. Why? Because from the market trough, 12 months later, every recession with the bear market trough, the average return over the next 12 months, 43%. Technicals, they looked bad the previous week. We've gone over our roadmap where we would allocate. We did allocate for the Golden Capital portfolio. That dropped below 3,500, I was a buyer because that was my game plan. This was my roadmap. We talked about including the 3,400s into this roadmap, 3,400s, and execute. Have a game plan, execute. Take the emotion out of it, folks. And you can do that by having a game plan. Let's see. So this weekend, we talked about the readings in the McClellan Summation Index. Rarely do we get below 1,000, let alone a negative 11,000 print. Happened here in 2002. It marked the lows, new bull market. Down here, obviously, during Q3, Q4 of 2008, yes, you still had a bear market until March of 2009, but a year later, after getting to these levels, the market was higher than where it was when the McClellan Summation Index was all the way down here. 2018, not quite as low as today, definitely 2020, and again, a year later, the market was higher than where it was at this point. I'd be willing to suggest the market will be higher than where we were on Friday's close of the S&P 500 with the McClellan Index right here. Something really bad would have to happen going forward for the S&P 500 to not be higher than where we were last Friday, based on this kind of breath washout. We looked at the new highs minus new lows. while the indices are making lower lows, there are a lot more stocks that are not doing that. We can see that through the new highs minus new lows, or what they call the net new highs for the NYSE. We're not as many stocks at the September low for the index. We had a ton of stocks making lower lows with the index. It's not the case on Friday or last week in general. It's even more apparent when we look at the month chart. This is the 1 month chart of the same thing, new highs minus new lows, but in the NASDAQ. And it's not just that Friday didn't have as many net new highs, which means more stocks are making 52-week lows, but we started Monday, Tuesday, Wednesday were down days in the market. So Monday, Tuesday, these are large numbers here, 700. Stocks were making new lows, plus 800. Friday, folks, was a down day in the market. The NASDAQ made a new 52-week low. Look at the net new highs. This is what we call a bullish breadth divergence. It's harder to make new lows in individual stocks at this point. Well, then how did we do it in the indexes? It's the heavyweights. These are cap-weighted indexes. So your large caps were still making lower lows, pushing down the indexes. But again, this is a very nice, significant breadth divergence. Another key, market internal analysis, if you will, is we've often found lows in the market historically associated with the Williams percent R and the ATR normalized, hitting their extremes. So this middle panel is the ATR normalized. ATR stands for average true range for the S&P 500. You can look at it for any indices. For this exercise, we're looking at the S&P. The Williams percent R is another breadth indicator that tells you, things are at extreme, oversold all the way down here. And the average true range, just if you were paying attention to markets last week, the range is expanded, volatility expanded. From the lows on Thursday to the high was a 5% intraday reversal. The trading range, it expanded. Usually when you get both of these indicators at extremes, you're marking a low of sorts. Now, typically, they both get to their 0.80 levels. We just haven't been able to do that with the average true range or the ATR this year, this cycle. I think that has a lot to do with the fact that we haven't been able to get to a 40 VIX either. But either way, it did hit the same point that it hit at the June lows. So we have all these breadth divergences we're talking about and washed out breadth combined with the worst ATR since the June lows with the Williams percent R that is extremely oversold. And you can expect some kind of rally or anticipate some kind of rally. And that's basically what I was thinking would happen this week. I believe that we would hold the lows from last week, at least for now. We're going through earnings season. What haven't we priced in? The S&P 500 is down 25% without a recession. What haven't we priced in? We know we've priced in all these rate hikes, right? Just from a quarterly basis, every time we get an acceleration in the expected terminal Fed fund rate, we make a lower low. So we know in real time that's being priced in. What about if earnings deteriorate? Again, we don't know to what degree, but all year long, we've seen estimates move lower. So we know there's some degree of forward-looking earnings expectations that are being priced in here as well. Let me see. Market being a forward. Okay. Thursday was one of the most bullish reversals we've seen. Then Friday was one of the more bearish reversals we've ever seen. As many stocks paired or even gave up more than Thursday's gains. All I can say is the S&P 500 would need to hold Thursday's lows, and most of you know the Thursday low, the year-to-date low, was 34.91 on the S&P 500. So we need to hold Thursday's lows, else this aspect of the game plan will demand greater consideration. And the aspect I'm speaking to is if we drop below 3,400, which I believe would be an overshoot, again, all that context is in here, I would be allocating 3 to 4%. I would be allocating at each 3 and 4% drop below 3,400. So if we didn't hold the lows this week, 34.91, more than likely, we're going to, cascade that much further down in price, and me adding would need greater consideration. My guess is that in the coming week, which we are currently in, those lows do hold, at least for now. And of course, I put east for now. I think we all understand what I meant. No, this is not a forecast, but my sentiment given the above or aforementioned analysis and the analysis that would continue when we look at earnings. A lot of stuff in here about earnings, pertaining to earnings. We always hear, well, in a recession, if you have, or not even in a recession, because we can have downside or year over year declines in earnings, and yet the market is still higher. That's the other thing. Everybody's, well, earnings haven't even come down yet. What if they're decline next year? Well, more often than not, the market's still up. Talked about that before. And there's a lot of myths that people promote, about the market. Here's just a blanket graphic, going all the way back to 1930. Percent of the time, returns are positive. When earnings are up, 72%. But what about when earnings are down year over year? The market is actually higher more often than not. It's 77%. Can you believe that? But you're afraid that earnings might be lower next year. As I've often said in the past, there's really, historically, when you look at down years in the market, they're only down for basically 2 or 3 reasons. And those are inflation getting out of control, or a war. That's generally it. All else is just intrinsic to investing. If earnings are down next year, investors know, and they're allocating capital because the earnings will eventually grow again. So they'll wait. Hence, just because earnings are down doesn't mean the market goes down that year. Another myth of markets is, well, when the Fed hikes and they're trying to loosen the labor market, then the unemployment level should rise. Oh no, right? Because if the unemployment level rises, people won't have paychecks, and that'll start to feed into consumer spending and retail sales, and earnings get even worse. And now we got a real recession on our hands. Well, remember the fact that generally when the Fed is hiking rates, they're hiking into a strong economy. It's not what people promote to be the case today, but let's just use that as a baseline. But here's the reality. The data says that when they start hiking rates, these are all the times since the 1970s that they started hiking rates. 1971 to 2022. The start of hiking rates, this was the unemployment rate. This is 1 year later. Look, it's lower. The unemployment rate went down. 2 years later, the unemployment rate went down. 7.0% unemployment rate went down. The only time it went up was right here, 1980. That's it. Just once. At the start of a rate hike cycle, a year later, was the unemployment rate higher. You can't make this stuff up, folks. But like I said before, there's a lot of myths out there. And we do want inflation to come down. right? Because more than likely the Fed will stop hiking rates, and look what happens after the peak in inflation. 1 year later, after the peak in inflation, more often than not, the market is higher to the average of 13%. Is that going to get the S&P 500 back to its highs? Absolutely not. We know that. Market's down 25%, 13% over the next 12 months doesn't get you there. But remember, your portfolio doesn't have to be just the index. And if you're dollar cost averaging, you don't have to have the index get back to its former highs. With that, I'm Seth Golden. Thank you for tuning in. Till next time, folks.